Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello and welcome back to the Massive Passive Cash Flow podcast. This is Gary Wilson, your host. We're glad to have you back. If you haven't done so, please feel free to subscribe to the podcast. It's on Stitcher, iTunes, iHeartRadio, actually 30 different channels. Whatever your favorite one is, feel free to subscribe. And some good news for you. You know, we've been mentioning these wonderful folks called investor agents out there in the world, and there's now a lot of them, and they're in 27 states. So the company, and I, of course, am part of this too, that created that. There's now a website you can go to called globalinvestoragent.com, and it's showcasing just the team of those agents who've been trained to serve you and I, to identify, analyze, and negotiate often on-market deals, okay? Which is a big deal right now. And by the way, they have access to every property in the United States. Every parcel, doesn't matter if it's residential, commercial, and every person. We know what if they have it, what debt they have, how long they've had the debt, who the debt's with, how long they've owned the property, if they paid their property taxes. We get all the usual stuff too that every company has, bankruptcy, probate, foreclosure. But this takes it a big step forward. So grab one of those guys and put them on your team, because it'll make your investing career a lot more successful. So in any case, before we jump into things, I just want to tell you real quickly, I do know our guest today, Jim Martin. Personally, we go back a lot of years, and it's a pleasure for me to have him, Jim, on the show. So Jim, thank you very much for joining us today.
You're very welcome. Good day. I'm glad to be here, and thank you very much for the opportunity.
You're very welcome. So what's interesting for everyone listening is years ago, and I'm going to guess this was probably 12 or more years ago, Jim and I worked together a lot. I had a brokerage company, and we worked with a lot of clients and a lot of investors too, by the way, and I was at the time actively investing. And we actually were working with another gentleman, maybe two other folks, to start our own lending business, essentially a bank, but not a brick and mortar bank where you go and see a Wells Fargo down the street, that kind of thing, but basically a bank nonetheless. And maybe if we have time, we'll touch on that. So Jim's pretty sophisticated and very knowledgeable. And I to this day still call him from time to time and chat. We both our sons were in Scouts, Eagle Scouts. So he's just know this, he has my full endorsement. If you're looking to get money, Jim's the guy. It doesn't matter. Jim, in all 50 states, is that right? Or close to it, or?
On residential, I can lend in all 50 states. I mean, for commercial, I can lend in all 50 states. Residential, I'm limited to. I can do all 50, but I would not be the lead loan officer on most of them. I'm licensed in like 7 states as residential, but commercial, we can do them all.
Good. Well, that's a lot of these folks. That's what they're doing. So let's do this. If you wouldn't mind. I just mentioned a little bit about you, but if you wouldn't mind, give the folks a little bit more of a background. What industry did you come from? Did you start off lending, and help them paint a picture of your life, if you don't mind a little bit.
Certainly. So I'm going to go back to the early 80s when I was in high school, and that's going to date me right there. But my father was working for a credit union. And I remember coming home one day and he says, I don't know how we're going to keep this savings institution going. We're paying out, savings rates at 12 and 15%. And the mortgages that we have on the books are at 4 and 5%. And, back then, there wasn't such a thing as a secondary market that these little savings institutions were using. So they were really in a pinch. And that was in the time of the 18 and 20% mortgage rates at the beginning of the 80s. Well, when I got out of school, I was always kind of intrigued by lending, and I started working for a local bank, and they put you through the mortgage department. I mean, they put you through each department in the bank as part of their training. And I started out in teller line and consumer loans and that sort of thing. And then I got to the mortgage department. I said, ooh, I really like this idea, helping people into their houses and so forth. And kind of rose up through the ranks with them as an underwriter, and then moved out of that town and went back to Pittsburgh, where I grew up, and ran mortgage companies, ran mortgage divisions, created wholesale divisions, was a wholesale account executive, was an underwriter for a number of years. And then I I was a wholesale account exec for a number of companies, and 2008, when it hit, it kind of really put the damper on wholesale lending. And wholesale lending is where a large bank or an institution like that will provide funds available to mortgage bankers and brokers. And in 2008, a lot of those bankers and brokers went out of business. So the whole wholesale channel where you're providing funds to mortgage bankers and brokers just really took it on the chin. So I went to work for a bank, and that's where I ran into Gary. And I was running, their consumer mortgages, running commercial mortgages through that bank. And turned it out that I was probably turning away more business than I could do. And then when I met Gary, we said, let's work together, and I'll get back into mortgage lending. And at that same time, I also created my own company. I created a commercial loan brokerage company, which back in the time was pretty much unheard of. There weren't a lot of people doing it. There still aren't a whole lot, but it kind of gave me access to a lot of the commercial lenders in the area and nationwide. And what I was able to do is take a lot of the turned down clients that I had and put them into lenders that we had nationally that may have had interest in that particular situation. That has been going really, really well for me for the last 12 years. And what we found is that each bank each lender has its particular appetite for a specific type of client or a specific type of property or a specific location. So you may be knocking on the door of Bank A saying, here I am, I want to borrow in this location. And that bank may say, well, that's not really our area. That's not our forte. We don't want to do that. And you're like, but you're my bank. Why can't I get a loan? And they're like, well, we're not doing that. So you might go to Bank B, and Bank B says, oh yeah, we lend all throughout that area. But unfortunately, you're trying to buy property type that we don't like. We've done those. We're not happy with them. And our portfolio there is all filled with them. So we're not doing the property. And you're like, for Christ's sakes, what are we going to do? So then what I do is I find which lenders have a specific appetite for what type of product, what type of location, what type of borrower. And so when that particular borrower comes and presents their situation, we're pretty able to match that situation with that particular lender who has that opportunity. And that's really where a commercial broker comes into play.
Yeah. Well, I tell you what, it's the what you're bringing to the table is invaluable. I know the market, appears to be heading into a correction, but the reality is money always follows good projects, management and good projects. And one of the things I will tell everybody who's a listener here, I was in banking myself for 18 years. And the reason the banks are at the top of the food chain is because they're generally pretty good with their money, So they have, with all the resources I have available to me, we've got tons of, online resources that we can look at data related to the economy, macroeconomics, microeconomics, the movement of money across state lines. We have access to summary views of IRS tax filings. We have a lot of data. Just imagine how much more the banks likely have available to them. They have full-time people, managing risk. It's all about risk. So they are always looking to deploy their funds. Banks wouldn't exist if they didn't make loans. It's one of the core functions of a bank. In fact, and I believe in the charters, it's a requirement that they lend money. Mm-hmm. So just keep in mind, you're dealing with the right people. I know there's people trying to do a lot of creative purchasing techniques, and I teach those too. But the reality is you're far better off getting conventional commercial money because it's going to be less expensive to do it that way. And by the way, if they approve it, you got yourself a good deal. They wouldn't approve the loan if you didn't have a good deal. So why not go with the people that know what they're doing? I know I'm making a lot of people angry now because they're, well, Gary, I want to do, whatever, no money down, owner financing, all these kind of things. And worse yet, hard money. Folks, it's called hard for a reason. So,
hard to repay.
Yeah, that's right. Jim can get you mortgages at a fraction of what hard money would cost you. I let you understand the logic, but I get it. It's part of the industry. We do teach it, but I want you to know if you can connect with a guy like Jim, let him look at things first before you ever make any decision on where you're going to go get your funding. So, hey Jim, if you would you mind touching a little bit about the actual lending industry itself? Like where does the money actually come from? Because it's not always. A lot of people think it's just sitting in the bank. And it's actually, that's not true. It's always being deployed somewhere being used. And sometimes they're, a small bank will borrow from a big bank, and a big bank will borrow from the Fed, and so forth. But if you wouldn't mind a brief description, because I want everybody to understand what really happens, how it works behind the scenes, if you don't mind,
Sure. And so there's a lot of different sources of lending, and each source of lending has their own source of funds. So I like to talk about a hierarchy of lending. So, when you're looking to borrow money, the best way to get it is the cheapest way, and the one that meets your particular requirements the best. Mm-hmm. So, the best way to get it is friends and family, because they're probably more than likely they're going to give you the best deal. And it's other people's money. So you may have rich relatives, or you may have people that that have some extra cash and wouldn't mind spotting you $50,000 for a nice return. Everybody, again, like nature, money abhors a vacuum, and it wants to be out there. It wants to be working. So if you're sitting there making 8 to 10% in the market, and you're like, oh, I know there's better returns out there, and you can show through real estate that you can turn a 12 or 15 or 20% return, then maybe it makes sense to borrow from Uncle Fred and take the $50,000 or $100,000 from him and pay him a nice return. So that's usually the best place to start. The next place is your own place. So if you have equity in your house or any other property that you own, use that instead of pulling from your cash. I don't like seeing people pull from their cash, because the more you pull from your own cash, the less other activities you can take into. Yep. So if you could take the equity out of another property, especially an investment property, and make that work for you, that's the best. And you generally get pretty good terms when you're pulling money out of your other investment properties. Now, the next line comes into banking. So let's kind of delineate that a little bit. Where do these, you said conforming commercial loans come from? So you have little local banks or credit unions, or even larger ones. And each one has their own specific appetite as to what they want to do for investment real estate. Some are very much into it, some are limited into it, and some are into it if it makes sense. So you have to understand that each bank has a portfolio, and a portfolio is essentially where they park these loans. And the banks and the credit unions, they get audited very frequently by the entities that the federal government has established to oversee them. And if they start seeing that there's too much of a specific type of property or specific type of loan or specific type of client in their portfolio, they will cut it back. So you may be dealing with a local bank that, in January, they were doing a whole bunch of investment real estate. And then you go back to them on March, and they come back and they say, no, we're not doing them anymore. We have too much in our portfolio. We got to wait for them to run off. We got to wait for them to pay off. Right. And you might be saying, well, you were my best bank. Well, now you have to start another bank. So I always recommend to my clients that they have one or two, and usually 2 to 3 strong banks that if they have relationships with 2 or 3 strong banks, they should be in pretty good shape, because as one bank goes out, another one might come in. Right. But anyhow, banks can do a couple things. They can take those loans and keep them in a portfolio, which means they're funding them from the sources of funds that they have. And they get a portion of their funds from assets that are under management that come in from clients, checking, savings, CDs, those types of things. But the majority of it comes from interbank borrowing. So they will go from, as Gary said, they may borrow from other banks, or they may go to the Fed window and borrow directly from the Fed. And what that means is they're borrowing from the Fed, and the Fed right now is at a 3.25% rate on their prime rate. So they'll add a margin to that. So they'll go to the Fed, borrow 3.25%, they'll turn around and lend to you at 5.25% or 4.25%, whatever their spread may be. And that spread is their profit margin. So essentially there's an endless supply of cash available from the Feds. There's also Fannie and Freddie get involved. The people who do the residential loans, they also do commercial loans. And they will pull mortgage-backed securities. So they will take a whole bunch of loans that they originate, bunch them up into a giant pool of funds, and then sell that off to real estate investors. So these are bond investors who are buying mortgage-backed bonds, and they're putting money into that because they accept the risk and say this is a pretty good investment for us. So those are usually the large institutional investors like insurance companies and so forth. They'll come in and they've got all these premium funds. They got to get a good return. So they'll buy mortgage-backed securities because they tend to be very, very secure and they perform very well. Mm-hmm. So Fannie Mae will put together a million or 2 million or $100 million portfolio and put it out on the market, and then investors will buy into that portfolio, and that's what funds the next round. So those commercial lenders, they all have different sources of funds. And then we start getting in the hierarchy. So after commercial banks, then you get into generally private lenders. So there are private individuals out there, or as I said, insurance companies and so forth. They have money to lend, and they'll make themselves available, and they'll have each of their own set of rules. Some only want the cream of the crop, 750 credit scores or better, or some want 2.5 debt service coverage ratio or something like that. They want the really, really cream of the crop, and they may have a lower rate because they're risk pricing it. Others will see an advantage or an opportunity to say, hey, there's a gap of people here or opportunities that aren't being serviced. They may be a little more risky, but if we price that risk in, we can make a pretty decent return, and they'll charge a higher rate. And then you finally get to the hard money. And hard money can come from any number of sources. A lot of it comes from individuals or companies that have done fundraising, and they have their own cash and they can lend that out. The thing with hard money, though, is it tends to be very expensive going in, very expensive coming out, and very expensive during the interim. But they're very quick, and there's not a lot of questions asked, and it might be the thing you need if you need to turn something very, very quick. So, I mean, it just depends on what the client's needs are. Yeah. But there is a hierarchy, and I like to go as a bottom or as low as I can in that hierarchy. So that's where the lowest cost is going to be. But as I said, each situation has its own special need.
Yeah, I agree. And something you touched on early on in that section was the fact that it's good to have a couple of lenders to go to. And I did, and I'm sure you remember, Jim, when I was aggressively buying up, people used to jokingly call me the king of Pittsburgh. It's like, everywhere I went, either I'd owned it or I'd been in it or sold it or whatever. And the amazing I could, even years later, I'm thinking I've been in that house, But the truth is I did have 5 different banks that I went to, and it wasn't that I had them compete against each other. It's because I knew that they had different silos. One silo would be like small deals, duplexes and things like that. And others would be, storage facilities and strip malls, and they'd have these silos. And when one silo became too heavily weighted, they would no longer make loans for that type of property in that silo, and it was frustrating because I didn't know how to determine that. Only they knew, because they know their data. The other thing too is they had what's called the loans to one ratio. So they would only be allowed to lend only but so much money to any one borrower. And you might be thinking, well, hey, Gary, I'm going to set up an LLCs. Well, I did too. I had bunches of them, but you still have to guarantee the loans as an individual. An LLC is they know what we're doing, and they're going to protect themselves. Remember, for a bank, it's all about risk reduction. So what I would do is I realized that they would tell me, hey, we're reaching our loans to one. I'd say, no sweat. The capitalization goes up and down, so I knew they'd be back again. But that was a really good strategy. Another thing, Jim, I learned, and I don't know if it's just me, but I really was able to develop those relationships more easily with the community banks. I mean, the big banks worked. I did loans with them too, but the community banks, I don't know why, it was just easier, and they would look more like at the project. And in other words, as I grew a portfolio, the property became almost more important than I was, because they knew if I get hit by the bus, there's still plenty of money coming in, but maybe that was part of it. But can you touch a little bit on that, and then also the conforming, non-conforming, just so people understand what that means? And community bank, some of them were what called portfolio lenders. They actually held the funds, held the money. They didn't, or held the note. Excuse me. They didn't actually sell the note or package it up like FHA backed properties. Anyways, sorry, I know there's a loaded question there, but couple things, terminologies, if you wouldn't mind expanding on for people, so I want them to really have a good education.
Certainly. So, I mean, I would agree with you. I tend to find that the community banks are some of the most responsive and most receptive to investment real estate. I have tried a number of times working with the larger banks, and they have an appetite. They certainly have an appetite, but their appetite for most of my clients does not line up. I find that the community banks will do the smaller loans. Now, here in Pittsburgh, you can still buy real estate for under $100,000, believe it or not. It's crazy.
Mm-hmm.
And that's one of the reasons why Pittsburgh is such a great market to invest in. And, you approach some of the larger banks and you say, I'd like to borrow, $85,000 for this investment property. They're going to say, no, sorry. I mean, if it doesn't have 7 zeros, they're not interested.
Yeah.
And there's some exceptions to that rule, but finding that is sometimes difficult. But as a general rule, the smaller institutions and the more local institutions are going to give you the best year in terms of, if you're falling outside of the rules. And when I say the rules, I mean, the larger institutions are looking for the $5, $6, $7, $8 million deals, and they'll be all over that, and they'll be very aggressive for that, and they'll be the perfect fit. But if you've got small town ABC lender, and they've got a $400 million asset size, they're going to be very aggressive to get that money out working, and they're going to hire people that want to get that money out as quickly as possible. And they're going to be very receptive to that. If you have a $5 billion institution, maybe they'll be active, but a $500 billion institution, no, they're looking for the big ones,
Right.
in my experience. And then there's always exceptions to the rule. You might have a very young, every institution, we tend to think of a bank as like Chase or Citicorp or something like that, but each of them hires somebody to go out and represent them. And that individual has their own goals and objectives. They're out there trying to meet their goals. So they're out there trying to hunt that money and get it out there. But, they can only work with the product that they got.
Right.
So what we find is that the programs that are available to the small community bank are very, very flexible. They need to get that money out, and they're open to suggestions, and they're flexible in the way that they structure loans too. So they like to be creative and meet the need of their quote unquote their neighborhood client. So I agree with you that the community banks in my world with the investor real estate have been the most flexible. As far as conforming, not conforming, so the general definition is a conforming loan is one that meets the product parameters that are most prevalent. So like 20% down, 660 credit score or better, debt service coverage ratio of 1.2, and I'll get into what that means in just a minute. So every bank, prepares their own parameters as to what they need for the loan. But in general, those are typically the conforming loans where you're 20% down, you're a 20-year amortization, 5-year resets, and you're going to have 660 credit scores and decent return on the property. Once you started getting away from that, you've got lower credit scores, you got less cash, you have a debt service coverage ratio under 1, then those are going to be considered your non-conforming. And as a general rule, you're going to pay more for those. Yeah. Now, you may be able to offset one aspect of that loan. So if you had a lower credit score, but you had a debt service coverage ratio of 3.5, the lender is going to be all over that and put you in a conforming loan.
Right.
But when you start meeting multiple issues, you need 10% down. You need, you've got those types of situations. Then you're going to be in the non-conforming product. Also, documentation. We can do programs without full documentation, so we don't need to verify taxes and identity of clients. We can go around that. And those programs are out there, but those are non-conforming. You're going to pay for them accordingly.
Yeah.
What were some of the other questions that you wanted me to address?
Well, really what I had to do was a portfolio lender versus one that's actually packaging their notes up and selling them. Like, what does it actually mean to people internally, I guess? Like, what is a portfolio lender, In
the residential world, the portfolio versus secondary market is a really, really big deal. And there's a lot of that. So a portfolio means the bank is making the decision. The bank has its own underwriting guidelines. And the institution, the lender, when the lender closes on the loan, you're making your payments and the lender's holding the note and the lender's going to do the servicing. So you're going to make your payments to that lender. If you have a question about, how the payment was applied or anything like that, you're calling up the lender and saying, hey, what happened to my loan? In a secondary market transaction, like the earlier explanation I made, those loans are all being packaged up. Usually in a million, well, in a commercial loan, 10 million at a time. And then they're sold off in the mortgage-backed securities. So someone in the secondary market is investing in those bonds that fund the next round of loans. So that enables a bank or a lender to provide a lot more funds. There's a lot more liquidity in the market because they don't have to wait until they get another deposit or another loan from the government. That being said, secondary is a loan that's being sold on the secondary market. Excuse me.
And for those of you listening who've ever invested in like Fidelity Mutual Fund Company, and you buy a fund that says mortgage-backed securities like Fannie Mae and Ginnie Mae, those kind of things, that's what you're doing. So a bank like Bank of America package up a bunch of the notes are attached to the mortgage. The note is the promise to pay. The mortgage ties it to the house. So they package those up. Hey, these are all these. They're sellable. They're marketable, just like any other thing in the world. So they would literally take the note that you owe them and say, "Look, I'm going to sell this," and then the mutual fund, would collect the payments, or whoever's servicing the fund, the mutual fund is collecting the payments. So you and I, investors, can invest in those, and when all that money goes, the bank then receives that money to relend it again, right? And they keep lending it over and over again, to probably up to 10 times. So it's what happened in the last recession. When that came out, it was back in the 70s. What happened in the last recession is, unfortunately, there was a lot of misinformation and fraud going on, because in the 90s, the government made it more easier for people to buy homes. They lowered their requirements that the banks were required to have. And it sprung up this whole entire industry of, you had the individual bankers themselves, and you had mortgage bankers and mortgage brokers and these different companies. And unfortunately, so they're not all like Jim. they were putting together, so they were selling these packages of notes on Wall Street, thinking they were a grade A plus paper, and they weren't. That's why things got really tough during the last recession as far as how to borrow. But really, I think the other thing too, Jim, that means is when it comes to the borrower, the reason why community banks could be more flexible is because it's not that they're not following the rules, they are following the rules that the federal government requires them to, but basically they're keeping the funds in-house. They're not creating that extra risk by selling them on the secondary market. And so in any case, this is really good stuff. If you wouldn't mind, Jim, we mentioned debt coverage ratio a couple of times, and I know a lot of people probably have heard it before, but might not even know what that really means. And in principle, they could probably figure it out. But do you have any insight on that? How do banks actually calculate debt coverage ratio, or what's acceptable to them? I know it probably varies, but a little bit of dialogue on that would be great too, if you don't mind.
Sure. So a lender wants to make sure that the property is going to generate enough revenue to offset the expenses and the debt. So what they do is they look at both aspects. What's the revenue that's coming into the property, and what are the expenses that are coming out of the property? And you as an investor, you don't want to buy something that's going to put you underwater every month. I mean, there are some investors that are investing for capital appreciation, and they may be in a position to afford a $200 hit every month to their budget, but banks don't like to see that. So what they do is they take a look at the gross income. So your rents, your miscellaneous income. You might have miscellaneous income such as laundry, parking, late fees, that type of stuff. Anything that comes in that's not rent. So when you add all that up, that's your gross annual income, so your GAI. Then from that, they take out what the expenses are. There's management fees, reserves, vacancies, whatever the landlord pays, which would be taxes and maintenance and advertising and insurance. And that gets you to your net operating income. Mm-hmm. And then from there, they have the debt service, which is the cost, the monthly payment multiplied by 12. So to give you an example, let's say you had $20,000 of gross annual income. And on an annual basis, your expenses were $10,000, just to keep life simple. So now we have $10,000 in net income. And what we want to see is, what is the debt service of that? Well, what the lenders want to see is for every dollar of debt, there's $1.25 or more coming in for income. Okay. So that net income has to be at 125% or more than what the expenses are. The higher you are on that scale, so if it's instead of $1.25, it's $1.50. If it's $1.75, that's the strength of the product, the project. And the higher that is, the stronger it is. And once you start getting below $1.25 or $1.20, then they start thinking there's not a whole lot here to cover just in case. Because we're making assumptions, lenders are making assumptions on vacancies. They're making assumptions on what collection bad debt might be. So there's got to be a little fudge factor in there, and that 25% is the fudge factor.
Yeah, I've noticed too over the years what's acceptable. Then, like you said, so it's really sometimes it's just the lender themselves. That's one bank. It's their minimum acceptable DCR or debt coverage ratio is 1.75. Others it's 1.25. But I also notice it does fluctuate sometimes. So if the bank themselves feels like they're at more risk, like they already have some troubled assets from troubled loan. Remember, a loan, folks, to you and I, a loan to us is a liability. A loan to a bank is actually an asset because it right. makes money for them. So if they already have some troubled assets, i.e. troubled loans, sometimes they'll increase the debt coverage ratio so that they make sure they're taking on less risky loans, for the time being. But what's interesting, when I first got into banking, I already had studied accounting, of course, in university. And when you study accounting, you're looking at it from typically a consumer's perspective. When you get into banking, all of a sudden your brain wiring has to switch.
Yeah, flip-flops.
Yeah. So for those of you listening, just a brief little quick lesson here. When a property goes into foreclosure, you may think, well, the bank's they got plenty of money. They have the house now. Well, you may think that sounds good. But the reality is the way accounting works in banking, that loan, when you defaulted on it, please don't ever do this, by the way, but let's say you did. It's not like that brings your books down to the zero, like it's net zero. No. It has a negative impact, it's like a double whammy, because now they've got this property that you and I would think is an asset. And to the bank, they can't really consider that an asset. It's on their books. It's called REO, real estate owned, and it's a liability. And the federal government, if it gets too big, they're what they basically risk, right? They'll come in and they'll start, dictating to the bank how they're going to run their business, and sometimes even force it to be taken over. If their loan loss reserves is not enough to cover what's in delinquent to a large degree, believe me, they're going to be, investors will be unhappy. Everybody's going to be unhappy, And worse, if they go into other reserves, that's disastrous for a bank. I mean, they will certainly run the risk of being taken over. So, I just want to let you guys know that it's not like it's free money and people don't get hurt. When people go into foreclosure, not only that consumer is hurting, but the bank itself is made up of people, and investors are people who invest in the bank. Everybody suffers. And that's why the economy took such a big hard hit the last time, because it's not just like you or I, taking the pain because we let something go to foreclosure. It affects so many other aspects of our lives and community and the economy as a whole. So, sorry, I feel like I'm preaching there for a moment.
It really does become a snowball. I mean, on just about in so many different aspects. On their balance sheet, it becomes a snowball because now they don't have that money to lend to the next guy. Yep. They have more property in the REO, and now they can't be as generous as they would be normally. And in the neighborhood, now you've got one house that's boarded up, and the grass is only cut once a month or twice a month or whatever it might. People know when a property is taken in, and that just kind of builds and builds and builds and snowballs off. And investors know this. You're not going to a bank foreclosure auction and the REO department and saying, "Hey, here's $100,000 house. I'll give you $100,000." It doesn't work that way. Right. Everybody knows that bank-owned properties go for discounts. The bank may carry that property at $100,000, but it's not going to sell for $100,000.
Correct. And they've also taken on a lot of additional expenses, lawyers' fees, court fees. I mean, it is a big deal, guys. So in any case, I know, Jim, we're kind of running short on timer, so I want to kind of wrap it up with sort of a summary. Now that everybody has like a good, summary education of what really happens behind the scenes, what are some of the things you can suggest to people to increase their odds of being successful when it comes to borrowing and especially when it comes to investing in real estate and borrowing money to do that? Like the top 3 things you should do, that kind of thing, or 5 or 7, whatever that is,
Okay. So in my world, when I look at applicants, the very, very first question I ask is, how are you going to take title? And this is something you don't want to just think off the top of your head and go, oh, I don't know. So the options are taking it in your personal name or an entity. And there are advantages to both, but your particular situation will dictate what's going to be best. And my recommendation always, always, always is to contact your attorney, tell them what you want to do. Make sure they know what your goals and objectives are. Is it asset preservation? Are you building a portfolio of these stocks? How long are you going to hold them? What type of program or what type of property are you going to buy? Are you going to flip these? Who are you going to put into these properties? So that's the type of information an attorney wants to know. And you should have a pretty good feel for that. Once you hear that, the attorney's going to tell you how to take title. That will determine what kind of financing we can do. On 1 to 4 units, we can do residential or commercial. And there are advantages to both. Once you get past 4 units or you start bundling, 2, 3, 4, 5 properties together into one loan, then it's all commercial. So the very, very first thing to do is get that information that you need. And you may want to talk to your accountant too and see what kind of advantages there would be. I don't know if there are any, but honestly, the attorney is the best person to talk to first before you do anything. Then once you've got that worked out, then you come to me and make sure you work with your lender who knows what your goals and objectives are and has the right product to take care of you. A lot of lenders are like a hammer. They've got one tool and everything's a nail. And that means that if they're a residential lender, no matter what you're doing, they're going to squeeze you into a residential loan. Maybe that's good for you, maybe it isn't, but you need someone who has all the tools in their toolbox and knows what they're doing. I would recommend that you get your credit taken care of. All right. That's before anything.
Yeah.
Credit is huge. And you want to get a score. I would shoot for a score of 680 or better. Honestly, the best score is 720. You get more keys to more doors with a 720 or better. But you've got to work on your personal credit, get that up there as high as you possibly can. The next thing, cash is king. The more cash that you can put together, not just to put into the project, but just to show that you have cash, is better. So get your personal finances taken care of. Don't carry debt in your credit cards. Get those taken care of and build up a nest egg. Even if you need $20,000 to buy an investment property and you show 40, you're much better. Your odds of getting approved are much, much better than if you only have 20,000, you scraped it together by shaking out the couch cushions. So make sure you have cash, you've got good credit. And then if your income is variable, if you're self-employed, you're a contractor or whatever it is, and you're thinking of growing your investment portfolio, maybe you take a couple of years and you don't take as many deductions on your taxes and you report more income, because we're looking at income to get you qualified. And if you're writing everything off and at the end of the year, you've got $3,000 in income and we look at you and go, you're not reporting enough income to qualify, don't scratch your head and say, wonder why they wouldn't get me a house. We can do it, but you're going to pay a hell of a lot more. So maybe it makes more sense just to pay taxes for a year or two and get some really strong tax returns for the year after or the year before you start investing in real estate. So those are some real quick hints off the top of the head. I mean, they're kind of self-explanatory.
Yeah. Well, I agree, and I really appreciate you doing that, Jim. And Jim, if people, is it okay for people to reach out to you? I mean, a website, an email address. I mean, whatever you're willing to share, because I got a feeling you're going to probably get some calls out of this, especially if you can do commercial in all 50 states. And mostly what we do is with investors is commercial, of course.
So my company is called SRT Financial, and I have a website, www.srtfinancial.com, or you can email me at jim@srtfinancial. Awesome.
Well, Jim, thanks again. I mean, it's good to see you, and I'll be back up in Western Pennsylvania myself in for another 10 days, I believe, and I'll be there for a month this time. So no, last time though you were, you know, at the what's the down in the weather, or what's the term?
Under the weather.
Under the weather. Sorry.
Yep.
I guess they get old timers, you know. But in any case, we'll have to catch up, and I'll fill you in on some of the projects we got going on. And for everybody listening here, you know, we really are lucky to have Jim on this podcast. I mean, and I know him personally, so it has even more meaning than just a really good professional. He's been a lot of years experience, and I'm telling you, if you want somebody on your team that knows what they're doing, I mean, you look him up, give him a call. I promise you won't be disappointed. And I rely on Jim today to help explain things to me sometimes, because I just get so much going on, and it's good to have somebody stable and calm like Jim. So
thanks, Gary.
Yeah, you're welcome.
I very much appreciate it.
Yeah, well, you're very welcome. You know, you've definitely earned it and deserved it over the last 15 or more years. So, and everybody listening, you know, Deb, check Jim out. Go to the website. You got his email. And also, while you're at it online, go to globalinvestoragent.com, search by state if you want to, or by name, and grab yourself one of those wonderful investor agents, because they have the tools and the strategies, and more importantly, the data to help get you on and off market deals. And then you call Jim and we'll get you financed. And also, if you wouldn't mind, leave a review for this one. Jim he's not in the business of doing podcast interviews. This was more of a special favor. So, but leave him a review, okay? Because that goes a long ways. That's how this business works, and we appreciate you doing that. In the meantime, take care of yourselves. God bless you and your families, and we will see you on the next podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.